Have you ever done this? You open up a trading chart, you start adding a few indicators, then a few more, and before you know it, your screen is just a total mess of lines and colors. It's honestly one of the biggest mistakes traders make. I mean, this quote just hits the nail on the head, right? Instead of getting a clear picture of what the market's doing, you just end up with total, complete confusion. But what if I told you there's a structured way to fix this for good? Okay, so here's our game plan. We're going to go from that chaos to crystal clarity by breaking down the 4 fundamental dimensions of the market. We'll look at trend, momentum, volatility, and volume. And then we're going to wrap it all up with how the pros actually use this stuff. So first things first, we need a major mindset shift. The goal is not to learn more indicators. No way. The real goal is to understand that every single indicator belongs to a specific category, and each of those categories answers a very specific question about the market. Because when you really boil it all down, the market only has 4 fundamental dimensions. That's it, just 4. And here they are: trend, momentum, volatility, and volume. Literally every indicator you'll ever use is just designed to read one of these 4 things. Once you get this framework, your chart becomes clean, structured, and, well, professional. All right, let's kick things off with the first and, you could argue, the most important category of them all: trend. This is all about getting a handle on the market's main direction. A trend indicator answers one simple question, and one question only. Is the market moving up, down, or is it just kind of going sideways? Everything in this category is built to give you a clear, no-nonsense answer to that. You've all seen this one, right? The moving average. Its whole job is to smooth out all that choppy price noise. Simply put, when the price is hanging out above the line, we're in an uptrend. When it's below, we're in a downtrend. It's a super basic but really powerful visual guide. Now, this is where the pros find their edge. It's not just about whether the price is above or below the line. It's all about the slope. See a rising slope? That tells you the trend has some real power behind it. But a flat slope? That's a huge warning sign that the market's just chopping around, and maybe you should stay away from trend-following strategies. Another fantastic tool in the trend toolbox is the MACD. It just shows the relationship between 2 moving averages, but in its own little window, which really helps remove the guesswork. Is it above the zero line? Okay, the market has bullish strength. Is it below? Bearish strength. Simple, clean, and super effective. Okay, let's move to our second dimension and see how this all builds on each other. We're now looking at momentum, and this is so important. Momentum does not tell you direction. It tells you about the power or the strength that's behind whatever move is happening right now. So the question momentum indicators answer is this: does the trend we just spotted have any real muscle behind it? Is there enough gas in the tank to keep it going? This is how you figure out if a trend is healthy or if it's about to fizzle out. The most popular tool for this job is the RSI, or the Relative Strength Index. As it starts to climb, it's showing you that buyers are getting stronger and taking control. And as it falls, well, that means sellers are getting the upper hand. But here's the thing. Forget just looking at overbought and oversold levels. This is the pro way to read the RSI. By its operating range. In a healthy bull trend, you'll see the RSI pretty much live between 40 and 90. In a strong bear trend, it'll hang out between 10 and 60. This is how you confirm the trend's health. All right, on to our third dimension, volatility. Now, this answers a totally different question and helps you adapt your strategy to what the market is actually doing. The question here is simple. Is the market active and making big moves, or is it quiet and just consolidating? Knowing the answer is absolutely crucial, because a trending market and a sideways market require 2 completely different ways of trading. And the best tool for this, hands down, is Bollinger Bands. It's basically a moving average with these 2 bands wrapped around it that expand and contract to measure how volatile the market is. And reading them is so intuitive. When the bands start to expand and get wider, that means volatility is cranking up and a big move is happening. But when they contract and get really tight, what traders call a squeeze, that's the market getting quiet, coiling up like a spring, and often getting ready for a huge breakout. Another great volatility tool is the ATR, or Average True Range. It won't tell you the direction, but it tells you the average size of the price swings. And that has a super practical use. It helps you set a proper stop loss that's actually matched to the current market conditions. And that brings us to our fourth and final dimension. And honestly, it's probably the most underestimated of them all: volume. This is what you use to confirm if a price move is actually legit. Volume is your lie detector. It answers the most important question of all. Is this move for real or is it fake? Because price can move around without any real commitment behind it, but a true, sustainable trend, that's always got volume backing it up. And this shows it perfectly. If price breaks a key level and you see a huge spike in volume, that's a strong, confirmed breakout. But if it breaks that same level and the volume is pathetic, that move is probably fake and isn't going to last. Okay, so this is where it all clicks into place. A professional trader doesn't just slap these indicators on a chart and hope for the best. Nope. They combine them systematically, with each one serving a very specific purpose. So let's walk through the process. You start by picking just one indicator from each category. Step 1, identify the trend, maybe with a moving average. Step 2, measure the momentum of that trend with the RSI. Step 3, understand the volatility with Bollinger Bands. And then the final step, 4, you confirm the move is for real with volume. And this really gets to the heart of it. The real purpose of indicators isn't to give you these magical buy and sell signals, it's to help you read the condition of the market. Because once you understand the condition, you automatically know what to do. You know whether to trend trade, range trade, just wait, or maybe stay out completely. This is what separates the beginners from the pros. So let's end on this because this is the single most important thing to take away from all of this. The indicators themselves don't make you profitable. Understanding what they measure and the specific question that each one answers, that's what really makes the difference.